Welcome to this explainer. Today we're essentially cracking open a high-level corporate intelligence briefing on a hidden system that has quite literally been running the world. And no, we aren't talking about the stock market, and we're not just talking about standard everyday banking. We're looking at a massive, master mechanical system that has controlled trillions of dollars in global energy, dictated international prices, and steered government policy for over 50 years. It's called the petrodollar. Honestly, if you want to truly understand geopolitics and the real story of modern economic dominance, you absolutely have to understand how this system works.
Okay, let's dive into this. On our agenda today, we've got a comprehensive executive summary. We're going to start with the global oil market, then move into the birth of the fiat dollar and the 1973 oil crisis. After that, we'll cover the resolution found in the petrodollar deal, examine the economic engine of petrodollar recycling, and finally, look at modern vulnerabilities and threats to the dollar. We are going to see exactly how this financial empire was built, how it operates like a literal machine, and where its armor might currently be cracking.
All right, Section 1, the global oil market, the absolute lifeblood of the modern economy.
To really wrap our heads around the petrodollar, we have to start by establishing the sheer scale and the incredible stakes of oil. For over half a century, one single powerful financial mechanism has controlled the market for this universally required resource. Because, oil isn't just the fuel you pump into your car or planes and ships. It's literally in the plastic of the phone you're holding right now. It's in the fertilizer that grew your breakfast. Because our entire modern economy completely depends on it, countries are locked in this continuous, never-ending cycle of buying and selling it. But here's the catch. Not everyone has it. Some produce massive amounts, like Saudi Arabia, while others consume massive amounts but produce very little, like Japan. And it's exactly this imbalance that creates such a massive, vital global market.
Moving on to Sections 2 and 3, the birth of the fiat dollar and the 1973 oil crisis. These are the inciting incidents of our story.
So how did the US dollar come to basically control this entire global oil market? Well, we have to look at the historical buildup. Think back to the end of World War II. While most of the world was in ruins, the United States emerged with its manufacturing base and its economy completely intact. This dominance led directly to the 1944 Bretton Woods Conference, where countries got together and agreed to make the US dollar, which at the time was backed by physical gold, the very center of the global financial system. But then in 1971, we get a major plot twist. President Nixon completely shocked the world by decoupling the US economy from the gold standard in what famously became known as the Nixon shock. This shifted the world to a fiat currency economy. That means value comes entirely from public trust and economic stability, rather than a shiny metal. Because the US economy was so incredibly huge, the dollar remained the world's reserve currency. But then, right on the heels of that, the system faced a massive geopolitical shock, the 1973 OPEC oil crisis. Arab oil-producing countries embargoed nations supporting Israel in the Yom Kippur War, which included the US, strictly to gain political leverage.
So the crucial point is the impact of this embargo was absolutely devastating. Almost overnight, the price of the world's most vital resource quadrupled, 4 times the cost. This sudden shock sent massive shortages rippling across Western economies and triggered severe, crippling inflation. The entire global economic engine was essentially seizing up, and a dramatic resolution was desperately, desperately needed. Which brings us to Section 4, the petrodollar deal, a true masterstroke pact. In response to this severe crisis, the United States executed a highly strategic, transactional agreement to secure its energy and financial future. Basically, the U.S. approached Saudi Arabia, one of the world's largest oil producers, with a very pragmatic deal. Saudi Arabia committed to selling its oil exclusively in U.S. dollars, period. In return, the United States committed to providing military protection and support to the kingdom. It was this perfectly balanced exchange of physical security for financial exclusivity. And here is where the absolute brilliance of the domino effect kicked in. Because Saudi Arabia was the heaviest hitter among oil producers, other major oil-producing nations essentially had to follow suit. And just like that, the petrodollar was born. No matter where you were in the world, if you wanted to buy oil from most major producers, you now needed US dollars to do it.
Let's look at Section 5, Petrodollar Recycling Explained. This is the economic engine of the whole thing. This is where we shift our focus to the mechanical loop that makes this global system entirely self-sustaining. Stop and think about this for a second. If every country needs oil, and oil is exclusively sold in dollars, what does every country practically need? Dollars. Let's look at this through the perspective of a non-oil producer, like Japan, for example. To keep your lights on, to keep your factories running, you need oil. To get that oil, you must constantly acquire US dollars,
keep massive dollar reserves ready at all times, and actively trade with the US or hold US assets. Let's literally follow the money to see exactly how this recycling loop works. Step 1. Countries all around the world use US dollars to buy the oil they need. Step 2. The oil-producing nations earn absolute mountains of these dollars. But, they don't just sit on piles of cash in a vault. Which brings us to step 3. They invest those dollars right back into US assets. We're talking about US government bonds, American companies, real estate, global markets, the whole shebang. This ensures those dollars flow straight back into the US financial system. And finally, step 4, because of this constant, never-ending demand and reinvestment, the US dollar stays permanently strong. It's a brilliant closed loop. And this brilliantly illustrates the 3 massive strategic advantages this recycling loop hands the United States. First off, there is constant global demand for its currency. People always need it. Second, this immense demand means the US government can borrow money far more easily and at much lower interest rates than pretty much any other nation. And third, it grants extraordinary foreign policy leverage. Because so many massive international transactions must clear through US banks, the United States can mechanically utilize financial systems, like economic sanctions, to heavily influence other countries. The whole system places the dollar squarely at the very center of the world economy.
But nothing lasts forever without a challenge, right? Section 6, Threats to the Dollar. Let's look at the system's vulnerabilities.
Like we said, every empire faces a siege eventually, so let's pivot to the modern-day challenges. Recently, we've seen nations like Russia, Venezuela, India, and Pakistan actively attempting to trade oil in other currencies, like the euro or the Chinese yuan. This is heavily driven by the BRICS trade alliance, a partnership of countries specifically aiming to reduce their global dependence on the dollar. Russia has increased oil trade with China in yuan, settled transactions in rubles, and significantly reduced its U.S. Treasury holdings. Meanwhile, China is actively promoting yuan-denominated oil contracts. But let's be super clear about what this actually is. It is a gradual shift, not an overnight revolution. These countries are selectively reducing their dollar use where it's politically necessary, especially when they're under sanctions. But they still absolutely use the dollar when it's convenient and efficient for them.
So the million-dollar question is, why do countries that are overtly hostile to the U.S. still trade in dollars? Well, it all comes down to the extreme friction of what we call switching costs. Moving away from the petrodollar is incredibly complex. If you suddenly switch currencies, you aren't just changing a payment method like swapping a credit card. You are disrupting deep-rooted, multi-year contracts. You are tangling up wildly complex financial hedging systems. You are impacting the entire framework of global shipping and freight insurance. And you're fundamentally altering global pricing models. It is a massive technical migration with severe economic friction. Think of it through this social media analogy. The US dollar system is established, trusted, and highly secure. Moving to a competitor currency is a little bit like when Facebook launched Threads to compete with Twitter. It is incredibly difficult to suddenly convince everyone to move to a brand new platform when absolutely everything of consequence is already happening on the established one. Overcoming those embedded network effects is a seriously uphill battle. Now, what's really interesting about this slide is understanding the dollar's ultimate defensive moat: high liquidity. The US dollar offers unparalleled liquidity paired with ironclad legal protections. In plain terms, this means a nation or a giant corporation can move billions of dollars internationally in an instant without crashing the market. Right now, no other currency currently offers that exact combination of massive scale and total security.
But wait, the challengers aren't giving up. And here's a bit of a plot twist. The petrodollar isn't the only battleground. Countries like China are also aggressively utilizing the global gold market to challenge the US dollar's grip. They're purchasing massive amounts of gold to break global financial reliance on fiat US currency, and it's causing gold prices to absolutely surge in the process. Which leaves us with a truly defining question for the future of global finance. Will the petrodollar system gradually dissolve under the weight of these targeted political shifts and alternative markets? Or will its massive switching costs and unrivaled liquidity secure its dominance for another 50 years? It's a fascinating standoff. Keep an eye on the markets, and definitely keep an eye on how the world pays for its power. Thank you for joining me for this explainer.